All right, today we're going to talk about credit and exemption limitations as regards the OECD model for tax relief, usually found in Article 23. But basically, here I'm going to be alternating between two Word documents that I have opened right here to discuss an example I've set up and some assumptions I'm going to set up. So here that I got from school and want to explain more thoroughly so I can listen to it later on. So basically here what we have is we have Ron is an individual who is a resident only in state R and is liable to tax there on his worldwide income. He runs his own small craft business both in state R and through the shop in state A. We'll go into where those profits are coming from later on down here. But and he has some investments in bonds and real estate. He has the following items of income. So he has profit right over here, profit right there. That's state R, state A. But he also has rent from a villa. He has interest. He has rent from a holiday villa. So we have like three states going here: R, A, and B. And then in state R, Ron is subject to the tax of these following rates. So it's progressive rate, tax rate for these bands of income. And in state A, Ron is liable to a tax of $1,500 on the profit he earns in state A, and a withholding tax of $20,000. Or excuse me, he's subject to a withholding tax of 20% on the rent from his villa there. This being the villa in state A, so he's subject to 20% tax there. In state B is subject to a withholding tax of 35%, both on the incomes, items of income from state B. So what we got going on over here is that. So basically the question is you create two different set of assumptions of double tax relief to be granted in state R to Ron. In creating your two sets of assumptions, you may use you may use only the exemption method and the credit method, but you can combine the two as you wish and may impose limits on the amount of relief granted. And you read the note below is what it says. For both sets, list the assumptions in bullet point form. Then set out how the double tax relief would be computed in Ron's case if you applied both sets of assumptions. It is not necessarily necessary to complete the computations to arrive at the actual figures. Oh, that's nice. And then compare so you set out how the double tax relief would be computed, and you don't have to go through it all, but we're going to go through it. And then you compare the impact on both state R and Ron of the two sets of your assumptions you have defined, and discuss the policy considerations that might guide a state in choosing either set of assumptions, and assess the probability the state would design a double tax relief system. So, and also the note is a higher mark given set of assumptions. There are substantial differences between your first and second. The highest mark will be given as if one set of assumptions, in your opinion, realistic, and the other one is likely not to be adopted in any state practice, and you explain your answer. So basically give a realistic one and give some unrealistic ones. So let's stick up over here with our tax bracket and where income is coming from. So we're going to deal with a realistic set of assumptions first. Some realistic assumptions for the double tax relief granted to state R or to an individual R. So the first set of assumptions is state R uses the exemption method for business profits and the credit method for passive income. The exemption method used for both for the business profit is an exemption with progression. The foreign tax credit for passive income is subject to some limit, which could be an overall limit, a country by country limit, a basket by basket limit, in which the baskets are defined in various ways, or less common item by item. Okay, so they basically just gave you a couple various examples right there. The credit limit is defined by reference to Ron's average rate of tax in state R. So those are the assumptions, but let's go down to computations. All right, so right here we got the exemption of Ron earns state A profit is 60,000 times 40,000 divided by 200,000. Okay, so where's that? And then so the reduction of his tax bill is 12,000. So where are these numbers coming from? So we're in state A, right? we got it over here. He's getting his 60,000, right? State A profit times 40,000 divided by 200,000 total income, and that equals 1,200. The foreign tax Ron pays on rent and interest, and therefore potential foreign tax credit, is the rent. So I mean, that's what we're doing over here, because that's where we got the rent from state A is 20% times. Excuse me. Yeah. So you know, you got 20,000 times 20% equals 4,000. That makes sense, you know, because we got the 20% withholding tax right here. So that makes sense. So his tax bill is reduced by 12,000 plus 4,000. The state B rent is 40,000 times 35%. Yeah, see, we got that right there. 40,000 times 35% is 14,000. State B interest 20,000 right there times 7,000. And the total foreign tax is 25,000. The credit for rent and interest could be limited in various ways, and those were the ways we had talked about. You know, you have the overall limitation, 60,000. This is the overall limit, which would be limited to 24,000. 60,000. You know, you got your 20,000 plus 20,000 plus 40,000 equals over 200,000. You got your country by country state A income, and you got the equation over here. So it's a limit of 6,000, but all you really need is for 4,000, because that's all what we're being taxed on. So 4,000 is credible because we didn't reach the limit. So that's nice. So state B is 60,000, and the credit claimed can be 18,000. So you add these two, you get a credit of 22,000 if you use the country by country. Using these same equations over here, basket by basket, assuming that each case rent and interest are in different baskets, you got your rent, which is 60,000. Where are we coming from over here, right? This number plus this number is right over there, and then you multiply that by 20,000 plus 40,000. You know, it's 60,000, 200,000. Credit limit is 18,000. You got your interest over here. 60,000 times 20,000 divided by 200,000 is a credit limit of 6,000. So the total credit is 18,000 plus 6,000 equals 24,000. So that's set one right there. That's what happened. And then you can compare these in multiple ways. You know, as you can see, there's several other examples here that we could go through. And we might as well. So, second set of assumptions. State R uses the exemption method for the profit and the rent from the villas, and the credit method for the interest. So we're kind of just splitting things up here. The exemption method is an exemption with regression. The foreign tax credit for the interest is limited to the state R income of the interest. State R might apply an overall limit, a country by country limit. Again, we're getting, you know, we're just laying it out right now. And but in Ron's case, the type of limit would not make a difference, because the interest on the item of income which credit is only for the item of income which the credit method is used. And the credit limit is defined by reference to Ron's average rate of tax in his income in state R. So go down to set 2. Exemption for Ron's state A profit and the rent from the villas is 60,000 times 40,000 plus 20,000 plus 20,000. So basically what we're doing over here, we got the 40, 20, 40. Yeah, 20, 20, 40, 40. Wait, no. Yes. Yeah. So the reduction in his tax bill is 24,000. The potential foreign tax credit in respect to the interest is 7,000, but this is limited by to 60,000 times 20,000 divided by 200,000. So the actual credit would be 6,000. The foreign tax Ron pays, and therefore the potential tax credit is 15,000. So that's set 3. So sorry about that. Let's go up to set 3. State R uses the credit method for all foreign income. That's nice. That's kind of unrealistic. But the credit is subject to some limit, which could be an overall limit, a country-by-country limit, etc. The credit limit is defined by reference to Ron's average rate of tax on his income in state R. So over here, tax, you set it up. You get it. This is the situation. Here's the situation continued on. I should have said that set 3 was kind of realistic. These are the unrealistic assumptions. Basically, that's the gist of it. But here's the comparison. The comparison to be made in this part of the question clearly depends on the 2 sets of assumptions chosen in the first part of the question, but the main point that guide a state in designing its method for double tax relief come in the comparison are the choice of exemption method or a credit method, or in some case the deduction method, which is not discussed further here because those aren't the parameters of the question. The exemption method is usually granted for only active income, and that's important, and sometimes for income from immovable property. So even states that are described as exemption states usually use the credit income method for passive income. Exemption method achieves capital import neutrality for the state in which investment is made. This method is chosen by resident states in order to enable its residents to compete within other states on the same terms as local residents. Capital import neutrality cannot be achieved by state itself, as it depends on the double tax relief chosen by the resident state. Credit method achieves capital export neutrality, but the resident state, not the state with the investment is made, but for the resident state, not for the state where the investment is made. Capital export neutrality means that the business resident, a state tax are subject to, in terms of state tax, are subject to the same level of taxation where they invest in the state or in another state. If the level of tax in the other state is higher, however, perfect capital export neutrality generally it cannot be achieved, as the resident state usually limits the credit to the amount of its own tax and the foreign profit income. Limits of this type of relief are: exemption method is usually chosen as an exemption with progression, otherwise taxpayer subject to progressive rates. Tax, you get a double benefit. Credits are subject to various limits, as you can see here, most generous item by item, but it makes it more complicated. The credit limit is usually computed by reference to taxpayers' average rate of tax, although at least one country, such as the United Kingdom, computes the limit using the taxpayer's highest margin rate, and states generally aim to preserve their tax claim on income and domestic source. So the DTR, double tax relief, of course, very rarely, if ever, is designed in a way that reduces that amount of tax. Even the most generous credit is usually limited to the domestic tax on the foreign income, so that the credit does not reduce the domestic tax on domestic income. The fifth set of assumptions above is for this reason very likely to be adopted.